What if I told you there was a way to invest in the Irish property market in 2024 with as little as €500 that currently yields an annual interest rate of 9% for investors? Considering that the most competitive of high interest savings accounts available in Ireland currently yield in the region of 4% per annum, a 9% interest bearing investment is quite an attractive proposition. Better yet, this particular way to invest in the Irish property market involves zero commissions, little to no ongoing time commitment, and it actively supports the construction of much needed housing in Ireland. So, is it too good to be true, or is it a genuine option for investors? In today's video, we seek to answer that question as we look at Property Bridges, the Irish peer-to-peer lending platform that bridges the gap between retail investors and property developers. We'll talk about what all of that means in just a second, but before we do, it's really important to call out that this video is sponsored by Property Bridges themselves. The guys reached out and asked if I could make an informational video talking about their platform. I regularly get asked questions about property market investing in Ireland, so there was a natural fit between their solution and a segment of my audience. This video contains my own independent research, thoughts, and opinions on Property Bridges and their offering. I'd strongly encourage you to do further research of your own, because as you'll find out later, having a detailed understanding of Property Bridges and their offering should be treated as a prerequisite for investing. If after watching this video you want to try out Property Bridges for yourself, you can do so for free by clicking the first link in the video description or pinned comment. Using this link supports me as a creator and lets me know that you found this video to be useful. All sections of this video will be timestamped for your convenience. So with that being said, what is Property Bridges? Property Bridges is an Irish P2P lending platform that was founded in 2018 by David Jelly, an ex-Jefferies options and equities trader. As per Investopedia, P2P lending is the practice of obtaining loans directly from other individuals, cutting out financial institutions such as banks as the middlemen. In 2018, David recognized that there was a chronic lack of funding in the construction sector, and at the same time, savers were earning next to nothing in the way of interest on their deposits. The idea was simple: build a platform that allows savers who are hungry for higher rates of interest on their money to actively lend that money to property developers. This makes sense considering that the interest rates on property development loans would be substantially higher than the interest rates available on Irish bank deposits, granted with significantly different risk profiles, but more on that later. Just 2 years after launch in 2020, Property Bridges and their community of investors had funded €10 million worth of bridging and development finance across Ireland, helping to fund the construction of over 100 residential properties. In 2021, the company secured a €100 million credit line from Aros Capital, allowing Property Bridges to act as a credit intermediary for larger projects of between €5 and €12.5 million. Given that over 33,000 homes are expected to be built in 2024 and around 300,000 homes between 2021 and 2030 under the Irish government's Housing for All policy, there will clearly be a demand for the type of finance that Property Bridges is enabling. In fact, as of recording this video, Property Bridges has over 6,800 investors with over €45 million worth of loans made across 129 offerings at an average loan to value ratio of 61.8% and an average interest rate of 7.8%. Plus, in the wider context of European Central Bank rates falling in the future, the timing of which is uncertain, Irish savers may once again be faced with the reality of unattractive deposit rates, even amongst the most competitive of current options like Trade Republic, Trading 212, and Raisin Bank. So an alternative investment option like Property Bridges could be a very worthwhile consideration for retail investors and savers. So how does it work? Property Bridges provides a 4-step process on their website that gives insight into how their P2P offering operates. The first step is the receipt of a developer proposal, i.e. a property developer approaches Property Bridges with a project that requires funding. The second step requires Property Bridges and their team to scrutinize the application based on strict lending criteria and to carry out credit checks on both the corporate borrower and their directors. Property Bridges also utilizes external surveyors to validate all costings and valuations that are assumed assumed by the borrower, and they perform ongoing checks to ensure that development is being carried out as expected. Once the application passes the due diligence checks, the process moves on to step 3, where the investment is offered to the Property Bridges investing community. At this stage, investors like you and I can contribute a portion of the requested financing in return for a stated rate of interest. Once the loan term has ended, the process moves on to step 4, where Property Bridges collects both the investor's original capital and accumulated interest and pays this money into the investor's e-wallet account, where it can either be withdrawn or reinvested into a new proposal. One of the most important things to understand when using Property Bridges to invest is that you're investing in Irish property market debt and not equity. In other words, your investment returns are linked to the repayment of a property market loan as opposed to the capital appreciation of Irish property and or the distribution of rental proceeds. Investing €1,000 in an offering on Property Bridges is not similar to investing €1,000 in the likes of Irish Residential Properties REIT or IRES. The latter would be more suited to those who are looking for investment returns that are linked to the valuation of Irish property and the receipt of regular income distributions from such. But perhaps the biggest question to address is how safe is Property Bridges? From a regulatory perspective, in 2023, Property Bridges received full authorization from the Central Bank of Ireland to act as a European crowdfunding service provider or CSP. This allows Property Bridges to operate as a CSP across all member states of the European Union. Obtaining this license from the Central Bank of Ireland is no small feat, and it provides comfort to both investors and property developers that Property Bridges is being subjected to the highest of regulatory standards. In terms of the actual loans themselves, outside of due diligence, Property Bridges operates a number of policies which serve to improve investment security. For example, Property Bridges provides first charge security on all of the loans available on their platform. In other words, all of the loans on Property Bridges are secured loans. This means that should the borrower default on their obligations to repay the loan, Property Bridges is entitled to take possession of the property or sell it on behalf of the investors. Albeit the smoothness of this process would largely depend on whether the repossession was challenged in the courts by the borrower. Regardless, this is the same type of collateral that a bank would require on a property loan. Another policy example will be the loan to value limit imposed by Property Bridges. Property Bridges imposes a maximum loan to value ratio of 70%. The value of this limit is that it creates a 30% buffer between the value of the property and the value of the loan outstanding, meaning in the event of a default, the market value of the property would need to incur a 30% loss before the collectability of the full loan outstanding will be called into question. Such a loss would typically only be expected in times of distress in the property market and or the wider macroeconomic environment. The value of the Property Bridges team and their collective expertise cannot be understated either in terms of safety, with decades worth of experience in banking and financial services between them. However, that doesn't mean that investing in Irish property loans with Property Bridges is without risk. It's not. And the risks need to be fully understood before ever investing a single euro. First and foremost, investments made via Property Bridges are not eligible for the €100,000 deposit guarantee scheme. Reason being, you're not making a deposit with a financial institution. You're lending your money to a property developer and you're collecting interest payments in return. Two very different things. This means that 100% of your capital is at risk when making these investments, and in the event of a loss of capital, Property Bridges is not liable for the loss incurred. However, as we previously discussed, there are mitigating factors in place to reduce the likelihood of a loss of capital, i.e. due diligence, first charge security, and lending limits. In fact, CEO David Jelly encouraged the Central Bank of Ireland to enforce proportionate marketing requirements, risk warnings, and disclaimers on CSPs, as well as improvements to advertising warnings to ensure that investors know for certain that their investment is not covered by the deposit guarantee scheme in the event of a loss of capital. Secondly, not all offerings on Property Bridges are created equal in terms of risk. You have different funding categories, different maturity dates, different LTVs. All of these factors and more need to be taken on board when choosing an offering that aligns with your own personal circumstances, as well as your their attitude towards and tolerance for risk. For that reason, it is advisable to carefully review the fine details of each offering either independently or in the company of a qualified financial advisor before making any financial decision. Make no mistake about it, there are many factors to consider, and this is best illustrated by using an example. Let's take offering number 129, Julianstown Housing, as an example. As you can see, Property Bridges highlights some key details about this offering, including amount raised, percentage raised, funding category, loan amount, loan rate per annum, property type, maturity date, term, and maximum LTV. However, that's just the tip of the iceberg. By examining the offering in more detail, we can see more pertinent information such as offering specific security, additional collateral, valuation information, borrower information, and much more. All of this needs to be understood before investing. It is not wise to invest without any understanding just because a 9% interest rate is on offer. I asked CEO David Jelly about the history of defaults on Property Bridges and the outcome of such for investors, to which his response was, "We've had 2 defaults. In one instance, we recovered 100% of the investor's capital and interest, and in the other, we recovered 91% of the investor's capital. In total, we have completed 56 loans, with 55 of these returning between 7 and 9% to investors, and one returning a 9% loss." It's also worthwhile noting that the majority of loans on Property Bridges pay back the original capital and interest accrued at the point of loan maturity, meaning your cash is locked up until the maturity date, which can vary between 3 and 36 months depending on the funding category and when you invest. There are some other important bits of information to be aware of when looking at Property Bridges as an investment option. Firstly, as I mentioned earlier, the average interest rate achieved on loans to date is 7.8%. So while the current offerings on the platform are providing 9% interest, it's important to be aware that rates can and most likely will be lowered in the future. Annual return rates ranging from 6.8 to 9% have been featured on the platform thus far. Secondly, there are no fees levied on investors by Property Bridges. Property Bridges makes money from the property developers who borrow using the platform, and the interest rate that is quoted on the offering is the rate of return that the investor will receive. Thirdly, you can invest a minimum of €500 and a maximum of €100,000 per offering on Property Bridges. This makes investing in property market debt highly accessible for those who have low amounts of initial capital to invest. Fourthly, it is possible to invest in offerings on Property Bridges via a pension, and to do this, you need to reach out to Property Bridges directly, and you must have a self-administered pension. Finally, the interest that you earn via Property Bridges will be liable to income tax, USC, and PRSI, and it's your responsibility to file the appropriate tax return and to pay the amount of tax that is owed to revenue. Property Bridges does not operate any form of withholding tax on interest income. In conclusion, Property Bridges is a welcome addition to the investment landscape in Ireland, one that is certainly worthwhile considering as an option for earning high rates of interest outside of a deposit structure. Their P2P lending platform is democratizing the debt market for property development in Ireland, allowing investors of all financial backgrounds to participate in a way that is regulated and subjected to high internal standards of quality. However, it goes without saying that the biggest barrier to entry in terms of investor participation on Property Bridges is knowledge. It's important that the investor is able to assess the suitability of a given offering on Property Bridges outside of the headline interest rate, and to do that, knowledge of the space is required. That knowledge can certainly be acquired independently by way of further research, or it can be obtained in the presence of a qualified financial advisor. But it goes without saying that blindly investing in projects for the sake of a high rate of interest is not the most sustainable of investment strategies. It's also important to reiterate that with Property Bridges, you're not investing in Irish property. You're investing in the debt that funds the construction of Irish property. That's an important distinction to make, and it means that Property Bridges will only be suitable to those who want exposure to debt-based investments in the Irish property market as a means to earn interest income. For those who are looking for an equity-based investment in the Irish property market, whereby you have an ownership stake in physical properties, the likes of an equity REIT may be a more suitable investment. With that being said, if you do want to try out Property Bridges for yourself, you can do so for free by clicking the first link in the video description or pinned comment. When signing up, you'll be asked for both proof of identity and proof of address. You can then deposit money to your Property Bridges e-wallet via bank transfer and get started investing. There's also a requirement to complete both a sophisticated investor and knowledge test, and to provide some information in order to assess your ability to bear losses, as well as your overall understanding of the risks involved. Bridgepeer Financial Limited, trading as Property Bridges, is regulated by the Central Bank of Ireland to operate as a crowdfunding service provider. Let me know what your thoughts are on Property Bridges in the comment section below, and if you have any questions on any of the content that was covered in this video, please don't hesitate to leave it as a comment. Thanks very much for watching, and I'll see you in the next one.